Hey everyone, welcome back to another episode of Questions with Matt and Mark. This week, Matt, we're going to talk a little bit about the volatility that we've experienced so far in December. So in your opinion, what's been driving that? Because historically, looking back, December has been a pretty good year or pretty good month in terms of market performance for the major indexes that we track.
Yeah, Mark. Viewers, what you're seeing so far in the month of December is volatility is back. And I would say two main narratives, Mark, are being discussed day to day. I'd say the first thing is the newest variant of COVID and how that's going to impact the economy. And I would say, more domestically than internationally, I think people are trying to disseminate how that's going to affect two main things, consumer spending and the supply chains. And I think the other area the market's focused on is the recent guidance by the Federal Reserve.
Yeah.
I think the Fed is being more transparent in that they're going to try to get inflation under control. And, beforehand, they were talking about upwards of 2 rate rises in 2022. Now they're talking it could be up to 3. And they're going to speed up the getting rid of the printing of money. They're going to speed that process up. So I think ultimately it's the market, digesting those two variables. I would say viewers, remember the market tends to shoot first and ask questions later. And you tend to see selling and money coming right back into the market once their worst fears don't come true. So I would kind of look past a lot of this short-term volatility because most of our viewers' goals are more long-term.
Yeah, absolutely. And another thing that I'll just throw out there is what we're going to be looking at here coming up after Christmas is what we call the Santa Claus rally.
Yeah, I was going to allude to that. What happens going into the end of the year?
Yeah, so yes. Typically when you look at the last 5 trading days of the year and the first 2 trading days of next year, that tends to be a pretty good gauge of what the full year is going to look like. And again, doesn't have to happen every single year, but looking back at history, it has been a good guide. So if the last 5 trading days of the year and the first 2 trading days of the new year are positive among that 7-day trading span, typically that bodes well for the market going forward for the next year.
That's correct.
And then I'll also throw out there, any year where the S&P 500 index is up more than 20% at the end of the year, the next year tends to be positive at about an average annual rate of return of about 11%.
Yeah, I think it's a misperception just because the market did quote unquote well this year doesn't necessarily spell doom and gloom. And I think so many people are watching, over their shoulders constantly. Is this the beginning of the next big correction? Is this the beginning of the next big correction? That we talked about this on our latest podcast. They plan to fail for the good times.
Right, exactly. And the other thing I'll throw out there too is while we haven't gotten the massive pullback in the major indices yet so far year to date, there have been serious corrections in most of the individual stock names that people track that have been 20 or even 30% off the highs.
Yes.
But it's just getting masked because there's been market rotation and there's been larger names propping up the major indices. So there's been kind of a quiet behind the scenes correction of individual stocks, in my opinion.
Absolutely has been. So Mark, you kind of identified the follow-up question I had for you this week. So listeners, we'll be back next week with another subset of questions with Matt and Mark, and we look forward to seeing you then.